Picture this. You put $500 into the stock market. A year later, you check your account and it's grown to $540. You think, okay, that's nice. Then you forget about it for a while. 5 years pass. 10 years pass. And suddenly, that same $500 isn't $540 anymore. It's over $1,000. And you're sitting there thinking, wait, how did that happen? I didn't even add more money. That's compounding. And most people have heard the word, but almost nobody actually understands how it works. They think it's some kind of magic trick rich people know about. It's not magic, it's math. Simple math that quietly builds enormous wealth if you just leave it alone long enough. So, in this video, we're going to break down exactly how compounding works in the stock market, why most people never let it work for them, and the specific steps to actually use it in real life. My name is Jack. If you've ever wondered how people turn small amounts of money into serious wealth, hit subscribe and give this video a thumbs up. Let's start with the basic idea. Compounding means your money earns returns, and then those returns start earning returns too. It's growth building on top of growth. Here's the simplest way to picture it. Imagine you invest $1,000 and it grows 10% in 1 year. Now you have $1,100. The next year, that 10% doesn't apply to your original $1,000. It applies to the full $1,100. So you don't earn $100 again, you earn $110. It sounds small, but stretch that out over decades and the difference becomes massive. Let's look at real numbers. If you invest $10,000 once and never add another dollar, at a 10% average annual return, after 10 years, you'd have about $25,900. After 20 years, around $67,000. After 30 years, over $174,000. Same original $10,000. The growth on top of growth is what does the heavy lifting. Now here's what most people don't realize. The first several years of compounding look boring, almost disappointing. Your $10,000 might only turn into $16,000 after 5 years. Not exciting. People see that and think, this isn't working fast enough, and they quit. But compounding isn't front-loaded, it's back-loaded. The real explosion happens in the later years, once the base has had time to snowball. Which means the biggest mistake people make with compounding isn't picking the wrong investment. It's not giving it enough time. Let me give you an analogy. Compounding is like rolling a snowball down a hill. At the top, it's small. It picks up a little snow, barely noticeable. But as it rolls further, it's not just adding snow anymore. It's adding snow to snow that's already stuck. By the bottom of the hill, that small ball is enormous. But if you stop it halfway down, it stays small forever. That's what happens when people pull their money out early. They stop the snowball before it ever gets big. So how do you actually use compounding in real life? Let's go step by step. Step 1. Start as early as possible, even with small amounts. Time matters more than the size of your first investment. Someone who invests $200 a month starting at age 25 will typically end up with more money than someone who invests $400 a month starting at age 35, because those extra 10 years of compounding do more work than doubling the contribution. Step 2. Reinvest your dividends. A lot of stocks and index funds pay dividends, which is money paid out to you just for holding them. Beginners often take that cash out and spend it. But if you automatically reinvest those dividends back into buying more shares, you're compounding on compounding. This alone can significantly boost long-term returns. Step 3. Add money consistently. Compounding grows fastest when you keep feeding it. If you invest $300 a month for 30 years at an 8% average return, you'd end up with roughly $450,000. You only contributed $108,000 of that yourself. The rest, over $340,000, came purely from growth. Step 4. Leave it alone. This is the hardest step emotionally, but the most important mathematically. Every time you sell during a dip or pull money out for something non-essential, you're interrupting the snowball. You're not just losing that money, you're losing every future year of growth that money would have generated. Step 5. Choose investments built for the long game. Individual stock picking can work, but for most people, low-cost index funds are the simplest way to compound reliably. They spread your money across hundreds of companies, so you're not depending on one company's success. Historically, the S&P 500 has averaged around 10% annually over long stretches, and that consistency is exactly what compounding needs to do its job. Now, here's the part that trips people up. Compounding rewards patience and punishes impatience harder than almost anything else in finance. Markets will drop. Some years, you'll check your account and see red numbers. That's not a sign compounding stopped working. It's part of how it works.
The snowball doesn't roll in a perfectly straight line. It bumps, it slows, sometimes it even shrinks for a bit. But over long periods, the trend has historically moved upward. Let's talk about the real difference time makes. If you invest $5,000 a year for 40 years at 8%, you'd end up with roughly $1.4 million. But if you wait just 10 years to start and only invest for 30 years instead, that number drops to around $610,000. Same yearly amount, same return rate, but losing 10 years at the start cost you nearly $800,000. That's the true price of waiting. So here's the step-by-step recap. Start early, even small. Reinvest your dividends automatically. Add money consistently. Leave your investments alone during downturns. And choose simple, diversified investments built for decades, not days. Compounding isn't exciting to watch in year 1 or year 2. It won't make you rich overnight, and it's not supposed to. But give it enough time, and it becomes the single most powerful force in building real wealth. The people who win with compounding aren't the smartest investors. They're the most patient ones. If this video helped you understand how compounding actually works, hit subscribe. And let me know in the comments, how many years have you been investing so far? Because the moment you stop interrupting your snowball, that's when it finally starts rolling on its own.